a part-time job in the Reward Options training program. And so what we're going to really quickly do, and this is kind of like going to be an impromptu video, is we're going to roll out 2 casino plays that are probably going to be in play next week. If you get this video today, which is going to be Sunday, August 29th, 2021, you may be in position. If you get it after that, you probably won't be in position, probably the way this play is going to move, which is a good reason why you probably want to be tapped into the content. Sub, like, subscribe. So if you're getting late, it is what it is. The market has an unlimited amount of opportunity, so you just going to have to catch the next one. This is probably the kind of play that I would probably normally, when I used to do my watch list, would put on a watch list, but I don't do the watch list anymore. But want to go ahead and just signal these out, and these are casino plays. So what do I mean by casino plays? These are plays that you normally are not part of the normal stocks that you normally trade, but they're casino. So what do I mean by casino? You go in and you really don't, you expect to win, but you're not really that bothered if you lose. The same way if you roll I forgot what to call it, that machine that you roll down the handle on the casino. You're just doing it because it's fun. And if you lose it, it doesn't really mean that big of a deal, even though you may expect to win, right? So you have high expectations, and you have a high degree of expectation for success. But because it is actually casino, it's not one of the main companies that you trade, you're really not tripping on it. Now, give you a disclaimer, this is not going to be investment advice. I'm not an investment advisor. I don't represent you in your investments. This is primarily information and entertainment. And to really be very frank with you, this is a high risk play, right? This is not a play. And these are the kind of plays that people get in trouble in because they don't really understand the market and they don't really understand what they're going into. And so what they do is they just take information on YouTube and they run with it. They over leverage themselves and they get hurt. And then they just look for the next home run. I know somebody that made $1 million off one of these tickers already, right? Off options plays. But they was in this way ahead of time. So I still think both these plays have some legs, but then maybe not as powerful as they were last week, because the person I know that made $1 million off of this, they was in this play 2 weeks ago. Okay. And we're going to kind of give you some of the basic fundamentals of why this could be a very powerful play, but you're going to have to take on the responsibility of actually understanding what some of the actual situation is, doing some due diligence on your own, as opposed to expecting that the information is going to be fed to you. We're going to just kind of touch on it a little bit. So the first play is going to be SPRT, right? So the ticker is sprtstock.com. And what we're looking at first is that we saw that their volume last Friday was 166 million. The average volume was around 13 million. So they already have really good trading volume. But it was 166. We saw that 52-week range went from 162. It topped out, I think, on Friday at 59.69. So they at one time was trading at $1.62. So that kind of tells you something about the stock. Let's go to the chart real quick. Let me show you the chart before we go to the statistics. So we're kind of looking at the chart now. Let's look at the whole chart. What do we see? It traded at around $2 for a very long time. Had a little bump up here, January, February, March. Traded in that range and then started to move up. So the person that made the $1 million options plays, they got in right about here, which is a great time to get in. Then you just exit here, right? So let me zoom in. Let me take it to the 1 year. So we're seeing this, right? So, massive jump up on the 27, massive jump up. It opened at 38. It went to a high of 59 and closed at 26, right? So got a big red bar here. Let's go to the 5-day. And we see the same thing on the 5-day, right? So this was that day, rolled up. This was where it topped out, sold down, right? So what you got to understand is that you had a massive move, but then that same day it started losing share value. People started taking profit because you had a lot of people that got in at $2. And unlike a lot of these other plays, they realized if I got in at $5 or I got in here, the time to get out is here. The time to get out. You got 1,000 shares at $2, get out at $35. Because you can always take some of that money and buy back in, but you took most of your profit out of the market. What I want to show you is why I think this is a very powerful play. To me, I'm going to show you 2 plays, but why I think this is the most powerful one is really because of the technicals, right? And what I mean by that is that it has a really small float. This float is small. It's 9 million. This 67% short percentage, I don't think is accurate anymore. But the problem is that particular data is lagging. So it could take us a week to actually get the data that's current today, and then that data will be lagging. So I don't still think it's at 67%, but I do think it's probably still over 25 to 30% short interest. And I think with the combination of this float, right, this small float, 52% being held by institutions, right? And they are probably not going to sell it now, especially at this price. This could be a very, very powerful play because you're not going to have a lot of shares available to be bought. Now, if people still decide to sell it, then it could hurt the play. But if people buying this decide that I'm just going to sit on my shares and I'm going to wait for this thing to squeeze up, this could be the short squeeze that everybody's looking for. Now, we already seen a massive amount of movement on the play, but I think this could potentially get even bigger. Why? Because the float's so small. The reason why I didn't like the AMC play is because the float is so big, right? So you never saw a squeeze because what you saw was a lot of demand on the shares, but the float was so big, you couldn't really push that thing up by making shorts have to cover. And that's why they're still waiting for shorts to cover. They're going to be waiting for a very long time because they can always find shorts to short it down with. In my opinion, they're probably going to run out of shares to short. And this whole thing about, synthetics and all that, these people really just making this stuff up as they go along. They don't really understand how the market works. None of that is new to AMC. It's part of how the market functions because everybody has the right to short a company as long as their brokers can find shares to short and they're willing to pay the fee, right? So a lot of things are being shorted synthetically. It's not just AMC. It's just a function of the market. So I think that this can be a very powerful play. The downside of this play from the first stand is that this is really a technical play. There's not really a fundamental story behind it. And nobody is spearheading this. So what we saw with the last two big meme plays is that they have personality. So the GME, you had the little roaring kitty guy. He was like the face of that play. People saw that, and what they did was they decided to become the face of the AMC play. So now, as opposed to one person, we had about 25 people on YouTube that decided that we're going to be the face of the AMC play. And that's kind of what created a community around that because you had faces. You had almost like a leadership of that play, right? And they saw that because they saw what Roaring Kitty was able to do with GameStop, and they understood I can make a lot of money just off YouTube if I become the face of the play. Nobody is really the face of this particular play. So there's not a narrative. There's not a story behind it. It's really just a technical play. And that's kind of what you got to kind of understand is it's really set up based behind the fact that it's a very, very small float. You got a really, really high short percentage, right? They're supposedly going into a vote for a merger around September 10th. I heard is the date. What a lot of times you see happens is after that particular merger date, after that vote on the merger, that particular date, you normally see companies start to sell off because that's kind of like the anticipation is over. So this, most likely will be a pump and dump. It's supposed to be something have to do with the Bitcoin space, supposed to be a Bitcoin play, but I don't think most people are looking to be in this long term. So this may just be ride this up to that September 10th date and get out. Now, as an options trader, this is one of the things. This has already hit the extent of its chain. I heard through the grapevine that Robinhood has already expanded the contracts out to 85. So most likely when we open up on Monday, these contracts would have been expanded out. But you're looking at massive amount of volatility. So I would anticipate volatility when we open up on Monday to probably be in the hundreds, probably be 200 to 300% on your strikes, right? But you got to understand, if this thing shoots up to 70 or 80, it won't matter. But that's the risk of the play. The risk of the play is that the volatility probably will be so high, right, on these contracts to where if you don't get the movement, the play is not going to work. Now, what I do like about this play is because we just currently now have monthly options, right? You have time. It's not like it's a weekly, because what they could do and what we saw them do with AMC and also GameStop is they stacked up the weeklies with a lot of really high volatility, and people bought them. And the problem was they just made the market maker a lot of money and nobody else any money. Because we have monthly expiration dates, because this was not a really heavily traded ticker, right? You have time. So if you get to September 17th, you got time. So you don't have to get a pop next week, right? You don't got to get a pop the week after that. You got time because the contract does not expire until the 17th. What you don't want is for it to start moving really hard in the other direction. So let's say we open up at 26. You don't want to buy, if you buy the 85s or the 60s, and this thing now dumps back down to 15, you could be in a lot of trouble because what do we get? We get volatility crush. So that's the risk of this play. What you would want is for this thing to bounce out to 85 and open up, and that option chain get filled up again. And if we can get that option chain to get filled up to 85 by the end of this week coming up, this thing may potentially squeeze out because the market may is going to start hedging to pay it out. They're not worried about paying it out because they got until September 17th to pay it out, right? And they may not do weeklies before the 17th. But if we can get into September with this thing already being extended past its option chain, they're going to have an issue. And you know what I'm saying? So then, but anything can happen in this market. So that's something that you really want to watch out for. Like I say, this is a high risk play. It can make you a lot of money if it goes the way you want it to go. You can also lose all your premium, and these premiums that we're seeing quoted today are probably going to be way higher on Monday, right? Way, way higher. And there's going to be a high implied volatility, which means what? You got to get the movement. The best time to get into this play probably would have been Friday or early last week. But I still think this thing has some legs, and I could be 100% incorrect. This thing could come out on Monday and dump back down to $10. Anything can happen. Okay. Now, what we're going to talk about is this next play. This is BBIG. Now, I don't necessarily like the technical aspects of this play as much as I like SPRT, but it all depends. So we're looking at average volume, 18,000. The volume on Friday was 238 million. Look at the 52-week range. It was one time was 111, went up to 940, came back down. Right now it's at 530, but you had a massive move from a percentage standpoint, but that's easy when you're trading at such a low dollar amount. Any movement is going to be is going to be really high percentage wise, right? So let's look at the statistics of this play. See, their float is 47 million, and that's really considered a small float, but it's not a 9 million float. A 9 million float with a high short percentage like that, if you can get people to start buying up those shares, that thing can go parabolic on you real fast. That's one of the things that I saw with Snow. It had a float. It was trading at around 17 million shares. That's why it shot up to $400. Because it was so few shares, once people started buying into it, it just became so expensive, and there was still a demand on the shares. It just shot up. And that's why Snowflake, which is a software company, at one time it was like 380, then it fell down from 380. But the reason why I got to 380 was because the float was so small. So they're 47 million. That is relatively small float. Short percentage is around 21% of the float. So we talked about before, that's lagging. This is not a really big float. And at the same way, if you can get a lot of demand in on this, a 21% short percentage is still very high, right? 21%, that's almost a fourth of the float being shorted. So that's still really high. And if you can get this thing to, to get a strong daily move from, let's say maybe, where are we trading at now? Let's say maybe $5 to maybe 15, that can be powerful. And it can put the shorts in a position where they got to cover. The thing about this is that it's such at a low price point, they would cover and then short again at the top. That's what they'll do. So you got to anticipate that going in. Even if we can get this to 15, shorts a cover, they'll cover, you'll get that really strong daily move. They'll cover and they'll short again at 15. Right? That's just how the game works. So you got to understand is that this is also, to me, low-key a pump and dump. They have I think they got a merger coming up, but there's really not a lot here, and you can kind of see that in the chart. They traded around top of the year, they bounced up, and they've been coming back down, movement, coming back down and bouncing back up. So based really on their chart, they're coming back down from this price point of $5 because every time they got around here, they sold back down. So just based on looking at pretty much the chart from the top of the year, they're coming back down on 5. So the question is, can the demand be created to get this thing to push back up 5, push past 5, excuse me. Looking at the options chain, they haven't topped out. So they're at 530. Their options chain ends at 750. So the goal this week has to be to get this thing to go past the options chain. That has to be the goal. And we're seeing, what are we seeing here? That volatility is in the 200% already. At 300% at the 750, right? 102 on the volume. That's crazy. People are buying deep in the money, which is really the safest play. I would get deep, deep, deep in the money if I could. These plays are going to probably come out Monday way higher. So you may see this 250 be $500 or $600 on Monday. What I do like about them also is they got just monthly expirations. So if you believe in this particular company and where they're going, I wouldn't even get a September play. I would get, this is not investment advice, I would get a January or April play if I could afford it. I wouldn't get a September play if I believed in where this company was going and the momentum. But like I said before, with these type of deals, what made AMC and GME so big was they had faces on it. There were faces of that particular play. There's no faces for these plays. So they might just be straight pump and dumps, kind of like Clove, get your money and get out, right? Or it may have some legs. What I do like about this as a trader is because the price point is so low, there's more room for us to get in, where with SPRT, there's less room because it's already had its big move. This has not yet, to me, really had its big move yet at the $5. right? It hasn't yet had its big move. I think this thing can probably potentially maybe get to 15 to 20 before you start getting a lot of resistance. So it's all on how you want to play it. But I like the SPRT more because why? It's such a smaller float. I think if you can get people to start buying that and not selling it, that thing could go up to $200. And I'm not saying that from an exaggeration standpoint because I don't like to exaggerate about stocks. But I definitely think it has that potential for no other reason than you just got a really, really small float, right? And then you got to hope that you can get your movement and before they come out and be like, hey, we're going to do an offering and we're going to dilute it because then that'll cause everybody to leave. So that's what you really got to understand. So what I would tell you first is that understand these are dangerous plays to be in. That's why they call casino plays. These are the kind of plays a lot of people get attracted to because they think it's a quick way for them to get rich in the market, and it is. But it's also a quick way for you to lose a lot of money because you don't really understand how to manage the risk associated with it. If you want to learn how to identify plays like this, and put yourself in a position to be profitable potentially, reach out to me about the highest paid part-time job in the world options training course, right? I don't break down companies like this all the time because I'm not a stock chaser. I do look for opportunity, but I tell people to really focus on specific companies and then have maybe one or two companies that you can play from a casino standpoint, because these are not going to be your bread and butter, but they can almost be like promotions, right? What I call a promotion is that, we have something that we run once or twice a year. It brings in a lot of money, but it's not really what our business is based on, right? But every company has promotions that they do, kind of like seasonal promotions. So once you really understand the marketing, you kind of understand how to break situations down and you understand the risk that you're taking to get involved in it, you can learn how to manage these type of situations, how to minimize the risk associated with it, but try to get the most amount of profit. But also when you see things going bad, exiting, understanding with this play, you're going to have to purchase a lot of volatility. Even if you purchase way out, the way they're probably going to stack up this options chain. Even if you purchase, and I don't see why anybody would purchase the December play, but even if you purchase way out, you're probably going to end up purchasing a lot of volatility, right? That's just how this play is going to set up because the market makers will want to see, do you want to buy these options at this price point? And if you're buying it, they're selling it, right? Their job is to create a market. So as long as you keep buying it, they're going to keep selling it to you at the price that you're buying it at. That's what you got to really understand. So that's my offer to you. I can show you how to capitalize on plays like this, but you got to be willing to do the work. You got to be willing to do some research on your own, and you can't be looking for the magic bullet, right? Because everybody that it hit this play is going to talk about how they hit it, but they're not going to talk about the plays like this, like Wish and other companies that they didn't hit on, that they lost money on. So if you got any questions, reach out to me. The links for the particular course will be in the description. This is David W. Williams, also known as Diamond Dave. I'll talk to you later.